Good morning. I'm Bruce Weber, Willem Quaker Dean of the Zicklin School of Business, and I'm pleased to welcome you to this episode of Zicklin Talks Business. The state of Delaware has a special position for business corporations. Over 2/3 of Fortune 500 companies are incorporated in the state of Delaware, and 80% of U.S. companies going public through an IPO make the state their corporate home. Having a Delaware registration, however, subjects a company to Delaware corporate law, which requires that companies act in the best interests of their owners, the shareholders. This has traditionally been interpreted as shareholder primacy, meaning that boards of directors with their fiduciary duties must focus on strategies that maximize profit and stockholder wealth and ensure that the CEO is the right person to lead this effort. In recent years, however, some, including Business Roundtable in 2019, have pushed for boards and CEOs to spend more time considering stakeholder interests. What about corporate activities that promote values that are viewed as socially good, especially those relating to environmental, social, and governance outcomes? Does Delaware corporate law allow for ESG activities that are not designed to maximize profit? Even further, is Delaware law at least partly responsible for the resistance the ESG movement has encountered in the United States? In this session, the school's namesake, Larry Zicklin, class of 1957, will discuss the rising scrutiny of stakeholder activism and company ESG activities with David Rosenberg, academic director of the Robert Zicklin Center for Corporate Integrity and associate professor in the Department of Law here at the Zicklin School, and with Adam Sulkowski, professor of law and sustainability at Babson College in Wellesley, Massachusetts. David studied at Oberlin College and earned his JD from the Cornell Law School in 1991. And after working as a judicial clerk and a lawyer, he joined Baruch in 2000. David is an expert in the areas of corporate governance, fiduciary duties, limited partnerships, and venture capital. Adam earned his MBA and JD from Boston College in 2000, and before that, his BA from the College of William and Mary. He has more than 50 publications on business, law, corporate social responsibility, and sustainability. After a decade at University of Massachusetts, he moved to Babson College in 2015. He's recently won awards from the Academy of Legal Studies in Business for the Outstanding Environmental Sustainability paper and the Outstanding Ethics paper. There will be time later in the session for questions from you, the audience. You can submit them anytime via the Zoom chat feature that will send them to Associate Dean Gwendolyn Webb, who will pose those questions to our speakers. Once again, our moderator is Larry Zicklin, former chairman of Neuberger Berman and instructor in business ethics in our undergraduate honors program. With that, I'll hand it over to you, Larry.
Thank you, Bruce, and welcome to David and Adam. Let's begin by seeing if we can agree on at least Delaware law. Can we agree that Delaware law focuses on the fact that directors have to act in the best interest of the company and its shareholders? Is that settled doctrine, and how rigorous is that? And maybe, Adam, you ought to talk to that.
So thank you, first of all, for inviting me to be here. And I think to answer your question, yes, but I think that when we pre-gamed this chat a week ago, we could all agree that there is some room still to interpret various things, depending on the time horizon, as either consistent with maximizing shareholder value, or in some minds it might not appear to maximize shareholder value, but others can still justify that over the long term. No, but wait, it will. And so there is still some room for discretion. And who has that discretion? That's one of the questions that Delaware law also seems to resolve, right? As you asked.
So you're saying that Delaware law has ambiguities about whether or not you have to act in the best interest of the corporation, and what is included in acting in the best interest of the corporation? After all, if the planet's to go up in flames, that's not in the best interest of the corporation.
Exactly. I think when we were pre-gaming this, it was useful to test my thoughts. So thank you for letting me say some of this stuff out loud and then think about it over the past week, and I will stand by this takeaway from our chat, that it really, some things will depend on the time horizon. And does Delaware law make it clear that, oh my God, as an executive, I need to maximize returns this month, this quarter, this year? I don't think so. Somebody please feel free to correct me. And I was just reviewing because I wanted to fact check and make sure I wasn't misspeaking on this point. There have been studies of ESG initiatives. There's one from a school down the street from you that aggregated, looked at 1,000 studies between 2015 and 2020. And then they looked at this 1,000 studies on ESG and financial performance and concluded that in most cases, it's beneficial to do ESG things. I know from having studied and published on this, it sometimes depends on the time horizon. It's like investing. I might move money out of my bank account today and invest it somewhere. That value might go down, but it might go up in the long term, depending on how the company's managed.
But that answers the question too easily, right? Because that's evidence that ESG decisions do benefit the interests of the shareholders, however we define the interests of the shareholders. I think what Larry really wants us to answer is, does Delaware law require corporate directors to make decisions that they believe somehow are designed to be in the best interest of the shareholders, whatever that means, right? So your examples clearly are in the interest of the shareholders.
Mm-hmm.
It seems to me that when we talk about ambiguity in Delaware law is intentionally ambiguous regarding what we mean by the best interests of the shareholders, regarding what we mean by a decision that's rationally related to shareholder interests or the interests of the corporation, because Delaware law has been so successful historically because it allows directors a great deal of discretion, right? In order to make risky decisions, in order to innovate, in order to tap new markets, in order to go beyond, in order to grow. And Delaware law is deliberately ambiguous in its language because as I said, it wants directors to have a great deal of discretion. And it seems to me it is so ambiguous, and there is support for this from some academic thinkers. It's so ambiguous that some decisions like the ones that I think Larry wants to talk about would slip through the cracks. Decisions based purely on the conscience or the ethics of the corporate director's own values that might promote, rather than shareholder profits, shareholder values in the sense of what shareholders think is good, not just for the bottom line, but good for the community, other stakeholders, for society, for the planet.
If you give directors that much discretion, which Delaware law does that enable them to do almost anything if they can make the remotest case that it benefits the corporation over an extended period of time?
Well, I think we have a decent idea of the parameters, right? And even in recent years, there are a number of cases, and historically too, of decisions that corporate directors made, that turned out not to benefit the corporation, though they were intended to. And of course, they're protected by the business judgment rule. But we have very few cases since the advent of ESG, almost none, where the directors wanted to make a decision that really plainly could not conceivably be imagined to benefit the corporation, again, whatever that means, in the very long run. And we have we have, a few cases where an ESG agenda was pursued and it failed. And of course, we wouldn't find the directors to have breached their fiduciary duties because they made a decision that they thought, for a variety of reasons that I think Adam is very good at articulating, would benefit the corporation in the short run or the long run.
And just to remind ourselves of the discretion that boards of directors have. When one of you emailed, can we mention the Disney decision? I thought you might be talking about the one I love to bring up from about 20 years ago, where there was an executive, a CEO, I believe it was Michael Ovitz, took over after Eisner, and I think he was let go after 10 months of pretty bad performance. Some of you are nodding your heads. I think the final severance package, he walked away with about $253 million of value for 10 months after getting fired. I asked my students, does that sound like a pretty good severance package? Would you be pretty happy with that, especially after being fired effectively? So fact check those data points, but I've always remembered the big takeaway to be this: shareholders, including one of the last remaining cousins in the Disney family, sued the board of directors and the company, and they said, wait, this cannot be right. You're hurting the company. You just gave away about $250 million to somebody after 10 months of bad work. That's not in the interest of the company, and you're not serving our interests. I don't think anybody would argue, and again, fact check everything I mentioned, that seems completely black and white against the interests of the company and the shareholders to give away that much to any CEO, especially after 10 months of bad work. And the argument was, I take this to reflect two major facts that I want all my students to remember. Courts, first of all, as we teach, do not look at the fairness of a contract in retrospect, right? Unless it's really unconscionable. Apparently, this doesn't cross the line of unconscionability. And two, yeah, as the board of directors, you have pretty wide discretion.
And they didn't expect them to stay for 10 months. They expected them to stay for 10 years when they wrote that contract.
Okay, so
and they were hiring someone, you know, it was a risky decision, but they were hiring someone who had a great reputation in Hollywood as someone who, you know, who had a potential to transform the business, and would only agree to do it for an attractive compensation package. And I think that decision by the board was well within the bounds of Delaware fiduciary duty law. It was not a disloyal decision, and it could easily be construed as good faith. And that's what the Delaware Supreme Court ultimately determined.
And we see that in the sports world all the time. Somebody signs a 10-year contract and they're a complete bust in year one or year two. And you say to yourself, that was a terrible contract.
But let's look at one of the more recent controversial case, the example of Pepsi, of Coca-Cola, Budweiser. Right. I assume that what you were talking about was their decision to use a trans actress to promote the product.
Yes.
Okay, as the audience probably recalls, Bud Light, you know, has been the most popular beer in the United States, but it was experiencing competition, particularly from some Mexican brands, and we're looking for ways to attract a younger audience. And someone in the marketing department decided to put together a promotion in which a trans actress would do a kind of online ad about Bud Light, and it proved disastrous. It caused people to boycott Bud Light, celebrities to boycott Bud Light. It resulted in their loss of being the most
number one brand
in America, and yet I think that decision, which was arguably an ESG decision, right? It was a decision to you know, promote diversity, which I suppose would be which could fall under you know, the.
Wait a second, David. Was it a decision to promote diversity, or was it a decision to improve sales using diversity?
I mean, it was I mean, diversity in the sense of who was buying this beer, but also arguably a decision to change the image of the company in a way that encompasses what we think of as diversity, right? To have, you know, not just athletes and sort of macho promoters of the product, but to expand in a way which might you know, create new markets. And it was disastrous, but clearly well within the discretion allowed by Delaware law as a decision that was made in good faith.
You know, you guys have
Bud sales. I just want to, just a factual matter, Adam, I'll get to you in a second. that caused Bud sales to be down 28% for the #1 beer in America. Which it is no longer the #1 beer. I'm sorry, Adam.
No, no worries. Thanks for adding that. I did not know it was that big a drop. Since you guys have brought up diversity, I just wanted to note that one of my former students is in the audience, and he actually took care of supplier diversity for Nike. So if we wanted to touch on whether he's familiar arguing with anybody in the legal department at any of the corporations he's worked in, whether any of the DEI initiatives were ever brought up in this kind of a light. I know that from the conversations that we have had, hello, Jason Cipriano, that actually I pushed back and asked, really nobody's shut down. I mean, how can you show the value of these DE&I initiatives if somebody's a skeptic? And one of his points is that, well, it might not be obvious to everybody. This is the kind of thing that, again, a board could shut down. Somebody could sue a board for agreeing to it. But there can sometimes be these surprise benefits, like discovering that the diverse-owned suppliers, whether they're founded by a woman, a minority group, a veteran, they often are newer than legacy companies. And so they will outcompete on price. They know that they have to deliver then. And so it has resulted in savings. Similarly, I'm going to throw a number just like the 28% that you shared right now is a vivid number I'll probably forever remember. 83% was the surprise cost savings. So I think that, we are in an era where DE&I might appear to be dead, or at least not in fashion. ESG might be out of fashion. There's 100 legal initiatives limiting discretion to look at ESG data. But I think it's important to, for anybody before they shut it down or, bother their board to shut these activities down, that there can be a return. Again, it's like what I came back to, and I understand it might be kind of a pat, easy way out to just say, well, it's a question of time horizon. But I think that's what we're finding is that these things do have an ROI. It just might not immediately seem apparent. Again, if you talk to the service academies where they train military officers, they were also arguing in favor of affirmative action policies because they know that diversity in leadership, if you don't have it, but you do have diversity in the people that you're ordering to possibly die, that doesn't result in unit cohesion or an effective organization. So as long as we touched on DE&I and the problems that can result if it's embraced in a certain way as Budweiser did, there's other situations where the data show that, hey, no, there is an ROI. So Jason, I hope I quoted you correctly, and thanks for being here.
But I would argue that if you are demonstrating to me that the costs were lower for this particular product, a Nike product, then you're arguing a P&L case. We're not arguing a DEI case.
Well, and that's, I love that question. And for me, it's always, my instinct is to say false trade-off, because I remember reading the story of Ray Anderson, founder of Interface, and his reaction as well, that, well, this stuff is green stuff. But then the further that they went on the journey, taking things seriously, they realized we're saving costs. When we can use our own waste or our competitors' waste to make new product, this is no longer a green issue. This is just a good business decision. So I suppose you guys are right that maybe it's a more difficult debate to talk about, well, what about when ESG or DE&I are not good for the bottom line? Yeah, that could be much more, full of consternation when you can't make something work. And maybe the answer is to approach your ESG initiatives differently, because in the cases that I love to cite that I've seen, it leads to good benefits for the organization. It just might not immediately appear that way. So yeah, I'm sorry to sort of stick with that because, yeah.
I want to sort of push the Budweiser case to the limit, and then maybe talk about the contemporary Disney case. Let's try to think of how the Budweiser decision might not have been made in good faith. If the actress had been the nephew, the niece of the chair of the board of directors, and he simply pushed it through because he wanted to promote her career, that would not be a good faith decision. That would be a violation of the duty of loyalty, right? Or perhaps if it was simply a matter of the political agenda of the board, They didn't believe that they had no evidence to suggest that this was going to increase sales, but they just wanted to use the power that Budweiser has to get Americans to think about gender identity. Even that, I think, might be able to slip by.
I would argue that. Why would that be able to slip by? Why are you acting in the best interest of the corporation when you have a particular political view of this, and it has nothing to do with the bottom line P&L of the company?
I think just because it could be justified as rationally related to the business, right?
How would you rationally relate it to the business?
I think if you could present evidence of exactly what was in the brains of the boards of directors and their intent, I think, yes, it would be considered either disloyal or bad faith. But I think Delaware courts are so flexible as to the motivation of directors that it would be that they would be reluctant to question such a decision. And I'm guessing that corporations get away with this all the time, where they take a political stand because of the personal feelings of the board, and justify it simply as a good business decision.
I would hate to be the corporate lawyer sitting in a board meeting and having the minutes reflect that the board agreed that this was not in the best interest of the United States, and therefore we're going to do this, and we're not considering what the bottom line P&L of the company is.
I agree. If it were in the corporate minutes as such, I wouldn't want to be that lawyer either. Can we talk about? Can we talk about?
But hang on one second. So what we're saying is, we can do something unless it's in the minutes, but you don't want to put it in the minutes. I just don't think we should be doing things that we're not willing to put in the minutes.
It's the Warren Buffett test, slightly modified, right? Don't do anything you don't want to appear in the newspaper and have your grandmother read.
Yeah, in a way. But it pertains to something else that David brings up. In Milton Friedman's line that he used in, I think, 1970, when he talked about the social responsibility of businesses to increase profits, he also talked about being clear about the rules of the game. He uses the word "the rules of the game," and since he is the icon for social responsibility and profits, do the rules of the game give boards some flexibility that within the rules of the game we're allowed to do these things? It's within our purview to do these things.
These things meaning things that might not necessarily be profitable, but we think are the right thing.
That might not be profitable, to use your term, Adam, in the short run, but over a longer period of time will prove to be profitable. For example, if you were operating a smokestack company and you wanted to clean the smokestacks, and somebody said, "Well, why is that in the best interest of the company?" And you said, "Well, it will make the town's inhabitants breathe easier, be less asthma."
Right.
Is that a good reason? I mean, somebody might say, "Who cares about the town? You got to worry about the P&L." Fair?
Again, this is absent a law requiring cleaner emissions. It seems to me that one could justify that on the basis of the need for the employees who show up to work at that factory to have clean air to breathe, and depending on the nature of the company, to have healthy customers in the community, and of course a healthy reputation in the community, right? It seems to me that decision, again, kind of like my earlier example, could be justified in lots of different ways as rationally related to the business of the corporation, even if it were motivated, again, in the minutes, not in the minutes, by the pure, simple desire of the board not to pollute. I do think that that kind of decision would get past a Delaware court because there are so many different ways to justify it. Remember, courts even justify will allow charitable contributions historically, even where the corporation doesn't take steps to get credit for it, or to reap the PR benefits.
How is that justified?
There are some historic cases about it where the corporation said, we need to foster a good relationship between citizenry and business. And even if our business in particular isn't necessarily going to get credit for it, the relationship between the community and the corporate world benefits, and that's good for business.
Yeah, but I would say that's a bottom line determination. I think you've made the case that in the long run, it's better for the bottom line of this company to have good relationships with the town. Or what if I make a contribution in San Francisco and I'm located in Miami?
Yeah, I think at the edge, that could be considered waste and would not be justified.
Seems to me the courts could be very busy on this.
They could be, and maybe they should be, because there's another line of cases that seem appropriate to bring up. Famously, what giving money is to political causes is what? Free speech, right? Corporations have free speech. We know this. Put two and two together. Yes, corporations can give money to political causes. And what's the justification? Well,
I tell my students, giving money to politicians is bribery. But we're just more subtle about it.
Right, exactly. Or as I joke with my students from abroad, when will you catch up with the United States? They gasp, and then I said, yeah, we've legalized bribery. You just have to pretend you're giving it to an uncoordinated group, and it's essentially limitless and can be anonymous.
But let's talk about that, because of course corporations justify political contributions on the grounds that they supported the election of a senator because that senator is against banning oil drilling in the Alaska wilderness where the company wants to drill, and that's clearly both legal under Citizens United and very well designed to maximize profits, right? And I think the train has left the station. There's nothing we can do about that. That is American law. And I don't think we would call that's not the bribery you're talking about, Larry, right? The bribery I think you're talking about is not necessarily knowing the senator's view on a certain subject, but making this donation so that they then feel obligated towards the corporation.
Well, they feel obligated. The corporations would argue they feel obligated to at least entertain us and listen to us and meet with us.
Yeah. In the lead up to the recent election, a prominent venture capitalist was sort of called out for making donations to both sides. And his response was, well, it gave me access. I don't know if those were literally his words, but he said something like, it gave me the opportunity to meet both of the presidential candidates. And that seems to me exactly what you're talking about, right? That's something in exchange. That is a quid pro quo for the donation, which Citizens United kind of skated over. And I think actually Justice Kennedy later expressed regret about his view of that kind of donation.
So here's what would be a really...
I'm sorry, Adam, go ahead.
Other people might be thinking the same thing. Wouldn't this be a fascinating test case to try out as a concerned shareholder suing the board for authorizing a political donation? And by the way, let's try this with donations to both parties or uncoordinated but aligned political action committees, arguing that your policies are going to visibly contribute to worsened inflation. That's the consensus of economists. And again, I repeat this. I would love to test it both ways through the Delaware system and find out if the argument works that you made a donation that just cannot be justified in the self-interest of the company, that it will lead to a worsened economic climate, and just see if how they react to it. Just see what the logic of the court is, because I don't know. I don't know. What if you could make that argument, and what would they say to it? Or would they just take the accept the argument? Look, you gave money just for access, and that's it. It's over. I think they would probably.
Larry's friends at the Center for Political Accountability put out a report, I don't know, 5 or 6 years ago, talking about how political contributions by corporations have led to a distrust in the public of government and indeed of corporations. And they show some evidence that that's true. And you could certainly make the argument that collectively corporate involvement in politics has contributed to a decline of trust in the government generally, and low regard for corporations, possibly including the individual corporations that have made those contributions. But I would be skeptical, like I think Larry would be, that a shareholder in any one of those individual corporations could bring a lawsuit against the corporation for, globally diminishing Americans' trust in their corporations.
No, I know. I don't think it would be that. I would try to make the argument that I think Larry is trying to test in this session, which is that what if just hypothetically, what if you could show that there is really no debate that your contributions, which skewed to one party, led to worsened economic conditions and worsened returns for me as an investor. You did this because of your own version of ESG, your own non-financial. What is ESG at the end of the day? I think what you're pushing us to discuss is what happens when the moral judgment, the ethical judgment of people that lead a company force them to make a decision that doesn't appear to be aligned with the financial interests of investors.
If I can push you with a real world example, let me just try this on you. Elon Musk aligned himself to a great degree with Donald Trump. His privilege. He is Tesla. You don't say the word Tesla without saying the word Elon Musk. I'm going to make this up. Half of the buyers of Teslas are Democrats and half are Republicans. I don't know that to be true, but it's probably much more than half. I agree. I understand. When he aligns himself with a political figure, forget who the political figure is, any political figure, is he not violating his fiduciary responsibility of loyalty to the shareholders?
Let's try it out. I'm dying to try. It's an even better example than what I was thinking. Yes, exactly. And I think it's been,
no, I don't think he is, because he is a savvy person who believes that the benefits that will accrue to Tesla through patronage by the new administration and preferential treatment outweighs the loss of the potential Democratic purchasers of his car. I do think your example, Larry, is very much parallel to the Disney case.
Let's talk about Disney
case. And
you better repeat the Disney case first.
Sorry?
You ought to repeat what the Disney case is.
Yeah, so, there was a rule passed in the state of Florida regarding teaching in public schools about homosexuality, which was popularly called Don't Say Gay, which was very unpopular among a lot of people. And the Disney Corporation, which is, of course, has huge operations in the state of Florida, took a public stand against.
They're the largest employer in the state of Florida. 75,000 people work for Disney in the state of Florida. I'm sorry.
And they took a stand against this rule and received a lot of retaliation, actually, from the government itself. And some shareholders wanted to sue Disney in a shareholder derivative lawsuit, saying that this decision, hurt shareholders and violated the director's fiduciary duty. And it did not get very far. They didn't even get to sort of do discovery in the case. And there is an opinion from a Delaware judge, and I have some of the language. It is not for this court to question rational judgments about promoting non-stockholder interests, be it through a charitable contribution, paying employees higher salaries and benefits, or more general norms like promoting a particular corporate culture, ultimately promoting shareholder value. The Disney Disney decision makers who decided to oppose this had many justifications for opposing it, based on the demands of their employees and the demands of their customers and the reputation of Disney as a kind of employer that embraces diversity in lots of different ways. And if you look at Disney's kind of reputation, you see that it does fit with opposition to that rule. At least there's a rational relationship between their desire to maintain their corporate reputation and opposition to that rule. And so the judge was not interested at all in allowing the case to go forward, because it was clearly protected by the business judgment rule, even if it resulted.
I would argue that it makes absolutely no sense for corporations to get involved in political warfare, because you're going to antagonize somebody. You're the CEO of a company. You have loyalty to the company and its shareholders. Why do you have to get involved?
Well, sometimes it works. If you ever drive down the West Side Highway, there's a storage company, Manhattan Storage, something like that. They're at big billboards, and every billboard has sort of a humorous take which criticizes conservatives, and sometimes in particular the president-elect. And that's because they know that the vast majority of people who might store their furniture on the island of Manhattan align with that view.
But you're making a bottom line decision. You're saying they're involved for P&L. Instead of doing an advertisement, they do this. But it's a bottom line decision. It has nothing to do with social responsibility. They're just making a P&L decision.
Yeah. As was Disney's decision.
I wonder if
But you could argue that Disney has been a very influential force in shaping American attitudes towards all kinds of different subjects.
And meanwhile, the stock got killed for a couple of years.
That's sort of tangential to what they do, which is ultimately to make money. But the way their movies have evolved over the years, from offensive depictions of Native Americans and other groups to being kind of extremely woke in the way that they portray fairy tales and folk tales. My kids are a little older now, so I haven't seen the current crop of Disney movies, but that's part of their business plan. But it has also, to a great extent, I think, shaped the way people think about certain things.
Meanwhile, Disney stock was very badly hurt. It brought in, I think it was Nelson Peltz, who wanted to get a seat on the board after Disney stock was under severe pressure for a year or two. I don't think in the long run, this helps a corporation to get involved in politics or social issues. Adam, how do you feel about that?
I'm of two minds, because first of all, what I think our colleague pointed out about, so first of all, I looked up the data, the surveys of political leanings of Tesla owners. It turns out that there are a lot more Republican than I thought. There's only a few, less than 10% difference in self-identification as Republican versus Democrat. The second largest market for their cars is China, and it's not that much. If you total sales in the rest of the world, it's actually greater. So you could argue that Elon's, like some people are arguing, that Elon's investment of 15 million might have been the greatest single investment that he's made, in the sense of he might be able to spare a trade war that somehow messes up their sales. Arguably, he's going to be able to skew government policy in favor of the company. And that made me think of the companies we sometimes love to hate, that of course they give money and of course they get fantastic returns. To your point of, does it ever make sense to give money to politicians or parties or causes, even when a majority of people don't like it, or when it's been clearly shown that it has led to bad public policy that is against the interests of most people? Well, look at what the fossil fuel industry has done. They've made their investments and they still, it's brilliant. I mean, it's loathsome, but I guess it's defensible. It's, is it loyal? Is it sloppy? Well, look at what they've gotten. You can still write off pumping oil out of the ground as depreciation because you've reduced the value of the real estate out of which you pumped. That's a fantastic tax break, right? So they've gotten a fantastic set of decades worth of tax breaks to the tune of tens of billions. As I think we might have mentioned in the prep call, I love to bring up the example that companies are still paying a rate set in the 19th century. The mining law of 1872, less than $5 per acre is still what a company pays to access federal lands, and we, the taxpayers, foot the bill for the roads and the cleanup. What's my point? All of these are intended to build towards the answer of, is it ever a good idea to give to political causes? God, I hate myself for saying this, but of course it makes sense.
Absolutely.
From the point of view of Delaware law, because yeah, you're getting an ROI. Are you arguably, contributing to a lot of very, very bad effects, whether it's, early death and disease of people, a much riskier climate to live in. On the continent that I'm on right now, 200 people just died unforeseeably because of a flood. Is it that controversial to say that these subsidies have been great for the fossil fuel business, but have contributed to a lot of misery for everybody else?
As part of my
directorship,
as part of my directorship at the Center for Political Accountability, one of the things I learned at one of the meetings, and it's not from CPA, it's from another study, is that political contributions enjoy a much greater return than lobbying. Which I think
it sucks. It sucks that we have to admit this, but it does not violate Delaware law. It is an example where we can argue that individual decisions like Elon's or the Chick-fil-A leadership or Disney's, that whether we love it or hate it, that there's clearly some aspect that is not strictly a financial calculation. They must see that there are both motivations and repercussions that are not strictly financial. And yet the ROI, the argument is there for why this is in the interest of the company. And so I guess it's legal. Yeah.
So wait a minute. So what I'm hearing is political contributions are a great source of rate of return of ROI. Then I would argue, if that's true, then that's bribery.
Well, but
a flaw in Citizens United was the statement that the way the system works with super PACs, there would be sufficient independence between the corporation and the campaign that it isn't bribery. And I think that is sort of factually untrue. But we're stuck with it.
I mean, I think we all know by now that it was, they were making up this fig leaf of legitimacy that, well, these PACs don't coordinate with the candidates, and there's not a quid pro quo. To address directly, Larry, your question, it's not bribery if there's not a quid pro quo. If you're giving money to a cause and it's not explicitly, do this and you will cut taxes for me, do this and I get a government contract, as long as there's not that element, as long as it's not given directly to the campaign, as long as it's given to a political action committee the way Elon did and plenty of others do, that's fine.
So as long as there's two events that happen, but there's no causative factor between the two events, you're fine.
And the
When?
problem is that now it's a constitutional right, right? It seems to me that that kind of activity is analogous to a company that pollutes but legally, right? A company that pollutes but legally is well within, Milton Friedman's formulation, and acting, in order to maximize profits. But there's always the possibility that the EPA is gonna, or the Congress is gonna pass a law that says you got to clean up your chimneys,
I
right?
suspect that won't be in the next 4 years.
Right. But there is no possibility, absent overturning Citizens United, that giving those kinds of political donations will be banned. And so the last resort of, the last resort of ESG, of course, is we can't control, the only way we can control the way corporations behave is by passing legislation. And we can do that for lots of bad behavior, but we can't do that for a First Amendment right.
And we don't seem to be able to pass any legislation. Gwen?
Oops. Hello, everyone. Can you hear me?
Yeah.
There are quite a few questions here, and one of the first that came in is, suppose we have a firm that's evaluating two positive net present value options. One is financially beneficial. Both have positive NPVs. One advances an ESG objective. The other has a greater financial benefit in the terms of a higher net present value, but less or no ESG value. Under Delaware law, does the firm have to choose the option with the higher financial value?
You guys follow the question? Do
Yeah.
you mind repeating? Yep.
The question is, does Delaware law direct the company that it has to go with the project that has the higher net present value, the higher financial benefit? Because net present value is on a present value basis that takes into the timing and risk of the future cash flows.
It seems to me
Yeah,
that, go ahead, Adam.
No, please, you take a first shot. I think I know my answer, but I want to hear yours.
It seems to me that there will always be, or almost always be, enough wiggle room under the ambiguous language of Delaware law to allow the less profitable ESG decision by justifying it based on other factors like the corporation's reputation, which of course is sort of more difficult to include in the present value of the decision. But if you could establish again in the minutes that that decision was made purely on the basis of the personal views and ethics and nothing else of the decision makers, then I think you could, then I think it could be called into question.
Adam?
Yeah, likewise, I was going to go with no. Business judgment rule, I think, allows for an incredible amount of board member discretion and the board collectively, and executives for that matter. So I'm going to stick with that answer. I've never heard anything. It's an interesting question. I wrote it down because maybe it's worth exploring. But no, I think that we've cited some examples in this conversation where you can justify all kinds of things that don't seem, in retrospect, like a very good investment. But if you can make the argument that, well, it seemed like a good idea and I didn't mean to hurt you, your decision is protected by the business judgment rule. I also want to bring up one more example, guys. Cracker Barrel was a case that I sometimes bring up. I think it was 10 years that they had an open official policy of fire your gay employees. And there were investors that revolted, customers that protested, all kinds of boycotts. And for 10 years, they resisted a vote of their own shareholders on this issue. Why? Business judgment rule, which effectively, to paraphrase, is kind of like, well, you investors don't like it. Sorry, but we're like parents and you're like kids, and we're going to tell you based on our superior judgment and experience that you're wrong and this is better for you. Deal with it. That's my answer.
Gwen,
Yes, Larry.
no, I just want you to go on with your questions.
All righty. Here's a question. Are the ESG advisory firms helping investors and companies identify which corporations are taking stakeholder concerns about climate, social issues, and others seriously?
So these are companies that are sort of their customers would be people who want to invest in a way that is consistent with their own ethics and consciences, and they rate funds or they rate corporations. I mean there's certainly a market for that. I think it's a fairly, at the end of the day, a small market, but that's very different from sort of advising companies about the impending environmental disaster that they need to take into account in creating their long-term business plans, right? Which it seems to me is a very important service which corporations ought to avail themselves of. But I think that's a different question.
So having worked with some of these people, I think that the general flavor of the advice is we are in a crisis, an environmental crisis. Here are the sequence of things you can do, and here's why you need to do them in this order to not have a revolt of investors, employees, and customers. So in my experience, the ESG consultants and the way that conventional wisdom on how you roll out these initiatives is to be mindful to, not make an investment unless you can show that, no, this will pay itself off. I can also share, though, that there's a former student with a fantastic company that advises on what to do with industrial waste. And I'll share one of the anecdotes that he shared over the last 15 years. He was stunned, absolutely stunned, that they wrote it out in crayon why an investment would have a very reasonable payback period, why if you did this to your industrial waste, it would turn into a supply for somebody else's supply chain. You'd be making money from your waste. And the company said no. Sorry, Gwen, are you cutting me off because I'm taking too long?
No,
no,
okay.
Go ahead.
Okay. So I just want to make sure this example is clear. Companies, the leadership of companies would say
what
no.
was the logic and why they didn't buy that argument?
Well, he was absolutely gobsmacked, and he would share his disbelief. And the only thing we could arrive at is, well, there's organizational inertia, which is the same as human inertia, and we can see it in humans that we meet. That, hey, we're used to a habit, we're used to something, we stay in that warm water, even if it's starting to boil, right? So there's individual inertia, organizational inertia. There could be some of the places where he gave this advice were very industrial, very conservative parts of the country where maybe they just could not be sold that, no, this green stuff is good. Look, here's the math. That was one other argument that was considered for a no that cannot be explained. And the final one was maybe stage of career, where somebody is, some people worry about legacy, and they get even more concerned with the non-financial legacy they're leaving behind. Other people might look at the months left until retirement, and they might think, well, why take any risk? Why rock the boat at all with a reform that will have some costs in the short term? If I'm not around to take credit for the benefits. We see that in the political sphere sometimes. So I don't have a strong answer for you. I wasn't given all the details. And if he had given me more details, I'd probably be asked not to share them. But I will share that example, that ESG consultants will lay out the math of why it does make sense and make sense within a reasonable time period, and will reap amazing benefits for your company. Instead of a cost center, you'll have a profit center. And people will still say no. And that just, I think, to me, reflects the incredible bounds of discretion that we give executives and boards, whether we love it or hate it.
But I would argue that what you're talking about is nothing new, right? Corporations, long before we had the term ESG or corporate social responsibility, a good company that you wanted to invest in had people anticipating new trends. of, a fishing conglomerate was already taking into account the fact that they shouldn't overfish and deplete the possibility of the stock coming back. Companies have always had experts who are trying to anticipate legislation that's coming up in the future that might affect the business, and competition and international conflicts. And the consequences, the environmental consequences, and the changes in the environment in the future are simply something that every company needs to take into account, whatever you call it. And a company that doesn't is simply a company that I don't want to invest in.
All right, thank you. We have time for just one last question. And this is really for Larry. And there's a lot of interest under Baruch students, some of whom are in your honors class. They are aspiring young professionals looking towards the future, and they're going to be in the job market. So in many cases, they have strong feelings that ESG matters should be pursued. In terms of their entry-level job in the professional workplace, would you advise them to look for companies that really are visibly promoting their pursuit of ESG goals? Or should they really just focus on getting the best job that they can to launch their careers?
You're out of my price range now, but I can tell you I would go for the best job you can get. Go, Adam.
Okay, so here's where we can cite what the executives would tell you. I brought up in the prep meeting, KPMG, if you want to look this up, anybody, do an online search for KPMG surveys on ESG reporting. And what the data showed from these large surveys, which then they pursued, they did like these little interviews with executives asking, is this data true, what we got from these anonymous surveys, that you guys are investing all this money to gather data on your ESG performance and share it because it's a human resource issue? It's not to please your investors. It's not to get the government off your back. It's not to find where the waste is. There's a whole bunch of other reasons why companies were given options to choose why you're doing this. And they said, no, it's about winning the war for talent. We know the best and brightest people on the market do their homework and they study us. And so when we are winning there's a limited number of super motivated, super awesome, educated people in the world. That's how they see the world. And they want the best. At least some companies do. Most companies do. And so they put out all that ESG data to try to convince you that they are the better story to buy into, where to commit your life for the next few years. They also think it helps with retention and with motivation, that all-important morale, which I've also heard anecdotally from Ray Anderson in person. He said, look, you cannot buy morale of the kind that you can with a good story. Just think of what humans historically do for the sake of a good story, whether it's religion or politics or whatever. Business leaders know the same truth. That look at Elon, for example, right? If you tell a great story and you excite people about that vision, that story, yes, ESG reporting is part of them telling that story to try to recruit the best talent. So look at that reporting, take it into account. Also be aware they are telling you a story. And so maybe you want to be a little bit, as with all data, with all information, be a little bit skeptical, use your critical thinking skills that you've absorbed at Baruch, hopefully at the Zicklin School. But do look at that data, because that is them trying to put their best foot forward, just like you are, and say, here's why you should commit the next few years of your life to us. Here are the great things we're working on to make the world better. Don't you want to be on our team? That's my answer.
Thank you very much, Adam. Thank you, Larry. Thank you, David. Thank you, Adam. It was a great session. Our hour is now up. Matt has put into chat the note of our next webinar. It's on December 10th. It's the outlook for commercial real estate in New York City. Larry's guest will be Mr. Stephen Riker, Vice Chair of Cushman Wakefield. So thank you again, Larry. Thank you, Adam. Thank you, David. And we'll see you all next month.